In March this year, when 3 US banks and a prominent Swiss lender collapsed, ripples were felt across the globe, spooking governments and industries alike. India, although safely placed, could not ignore it.
Recent events in the banking landscape of the United States and Europe suggest that risks for an individual bank could crop up from segments of its balance sheet which might have been considered relatively safer. Hence, we expect the management and board of directors of each bank to continually assess the financial risks and focus on building up adequate capital and liquidity buffers even beyond the minimum regulatory requirements.
The government, meanwhile, has highlighted several aspects to say that a similar meltdown was highly unlikely in India. Most domestic banks, both private and government, are in pink health. Asset quality of public sector banks has improved significantly over the years. Their gross NPA ratio has declined from the peak of 14.6% in March 2018 to 5.53% in December 2022, and close to 63% of the total deposits are held with these state-run banks. But at the same time, the banking regulator has been emphasizing on improving governance of PSBs and regulatory and financial transparency. So, are PSBs facing some troubles?
NIM will be under pressure for all the banks because as the bulk of the deposit portfolio get repriced, then the NIM will be under pressure, which has not yet been the case. As far as public sector banks are concerned, if you look at the two sets of private banks and public sector banks, the difference between deposit growth and credit growth is far higher than in public sector bank than the private banks. So, for instance, one public sector bank is deposit growth is minus, but credit growth is some 20-odd%. So certainly, yes, in that sense, they would need to attract more deposits and pay higher. That's an issue.
Governor Shaktikanta Das has emphasized on greater involvement of independent directors in board of banks. He said that independent directors should have loyalty only towards the bank and should be free of management and controlling shareholders. This comment, which comes after the top brass of the RBI recently held a conference on sustainability with heads of banks, suggests that public sector banks should do more to improve transparency and governance.
If you have to define, the role of independent directors in the public, banking system to begin with, and then public sector particularly, that there is more participation on compliance matters. Gradually we will realize that the board and particularly the independent directors have to get into the strategy aspect, the business plan aspect more and more, risk management frameworks a little more closely than it was earlier, much more closely than it was earlier. So to that extent, I do sort of support that observation. Public sector, the whole appointment of directors, are the board NRCs in a position to really appoint or take new independent directors? Those questions have always come up.
In FY23, 5 largest public sector banks received much higher deposits than private sector banks. The total deposit with these PSBs stood at a massive 8.43 trillion rupees, of which SBI alone received 3.72 trillion rupees. At the same time, top 5 private sector banks together registered a total deposit of 6.6 trillion rupees in FY23. A key point to note, however, is that the rate of growth for PSBs is skewed. While credit growth was 15% year-on-year in FY23, the deposit growth rate was 9.58%. So, will PSBs come under pressure in the near future?
When the rate hikes were happening, we saw almost, over 2 years period, we saw a hike of 250 basis points. Now, the transmission of those rates, that happened more on the lending side. Deposits, however, took a little longer. Deposit rate hikes, wasn't in keeping with that lending kind of, let's say, transmission. Now, this is going to certainly create asset liability management situation. So what you're really doing is you're funding for very short-term funds. If you're borrowing from money markets or interbank, then you are actually borrowing at short-term funds and applying them for long-term. Now, what may happen is, when the rate reductions take place, the NIM will certainly come under pressure.
Another key thing that might prove troublesome for PSBs is the rebound cycle of non-performing assets.
As we speak, both the gross non-performing assets as well as the net have come down dramatically. Other part of it, the so-called provision coverage ratio, or the PCR, is pretty high. But have we seen the end of it? And now the cycle, will it turn around? Well, as far as the corporate assets are concerned, I don't think there is any concern. But as far as retail assets are concerned, I see there are certain concerns purely because of the fact that the interest rates have gone up. About 44% of the all bank loans are now the external benchmark rate. All MSME loans are linked to external benchmark rate. So my understanding is this: some banks are seeing the SMAs are being created.
Experts believe that net interest margins of public sector banks are bound to come under pressure, and going forward, the challenge before the lenders will be to strike a balance between credit and deposit growth.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.